Okay, we'll go ahead and record it. So, okay, so being in US, we have a lot of opportunities to invest in real estate. So really the main thing that I wanted to cover, and hopefully it'll be a little more of a discussion than me talking at you, is basically I wanted to show you what it sounds like to talk to our clients about investing in real estate, what that conversation looks like, what the options are, what the consultation would look like, how we can add value to our clients, all that sort of thing. So we'll go through a lot of different ways. We're just going to go through a lot of the different ways that you can make money through real estate. And I think by knowing this stuff, we can help our clients to understand it better. And especially in a market like today, because we're not in a, we have higher interest rates than we did before. Still not very high, but, higher than we did before. And so that scares a lot of people away. So we've got to be able to bring people back to, hey, why is it a good idea to invest in real estate? Show them the opportunity. And to be able to just go show them that there's not just one reason why you get into real estate. You don't just get into real estate because interest rates are low. There's a lot of pieces that go into it. So that's what I want to go into. So the first thing, when we're meeting with investors, so how do you think a conversation happens with an investor? Like, it could be something as simple as, oh, hey, like I've always wanted to invest in real estate, right? Or, oh, I've always wanted to do that. Or you could say, oh, I'm doing this investment project. And they might ask a question like, oh, what does it take to get into that? Or whatever, So there's a lot of different ways that could open, but we're talking pretty easy, casual conversations that we'd be having. So anyways, and this can be the same for someone who's just buying a home for themselves, because it's really the same concepts. They look a little different depending on what they're trying to do, but it's the same concepts. So there's benefits to owning real estate. Investors want to own a lot of it. Homeowners want to own at least a little slice of it, right? So, okay, the first thing when we set an appointment, you always want to set an official buyer consultation, just like we would with anyone else. It's got to be a legitimate buyer consultation at a certain time, certain date, a certain place. It's got to be as professional as possible. You want to keep it super professional, because otherwise it's going to be a couple of friends talking about real estate, which is fine, but it's not very productive. So you want it to be as professional as possible and bring as much detail as you can. Anyway, so when you go to sit down with them, the main question is, hey, why are you interested in investing in real estate? And that doesn't sound way different than a normal buyer consultation, but it's important because you got to find out what's important to them. What do they want out of this? People want different things, and it's going to change what you're going to advise them on. So you always ask, hey, why is this so important to you? Why do you want to invest in real estate? What do you want this to look like? And you don't want to get pigeonholed into like, oh, we really want to do this kind of project, or we really want to do whatever. Like, are you looking for cash? Are you looking for income? Are you looking for assets? Are you watching your net worth? Like, what is it? Is it financial independence? Is it passive income? Or is it like, what do you want? And then you can kind of help funnel them into the different areas of real estate investing. So if they say, again, we'll kind of piggyback. So this will be normal home buyers and investors. They want the same thing. It just sounds a little different. So let's say it's an actual investor. So they want to invest in real estate. Awesome. Why do you want to invest in real estate? What's important about that? What's it going to do for you? And then we can kind of help them funnel into which projects would work better. So there's a few different types of investment projects. I'm sure there's more. There's definitely different sections, but the few that I could come up with, flip, right? We all know what a flip is. What do you think the benefit of owning a flip is going to be? Like, what's that going to do for them financially?
Lump sum of cash.
Cash, yep. It's going to get them some cash. And
so is that flip for a long-term hold or a short, or just a sell? Like flip it to sell it?
Yeah, I mean, I would say flip. Yeah, normally would just be to sell it. So you flip it, you sell it. You buy it low, you sell it high, take the cash in the middle, right? Mm-hmm. So that's really the benefit of it. That's the benefit of a flip. So if you're looking for income, a flip is a pretty good option. I mean, obviously there's some negatives to it. Like there's some risk. they're pretty active. Like a flip would normally be considered pretty active income because it's going to require a lot of work, right? A lot of effort, a lot of time, a lot of money. Um, but it's going to bring in cash. So if you're increasing your income, then you may want to do a flip. So that's the big benefit there. What if you were going to, like you said, Carla, what if you were going to hold it long term? So whether you flip it or don't flip it, but you're going to buy it long term, what's that going to do for you? What are the benefits that you get from a long term flip? Like why would someone, or not long term flip, sorry, a long term investment property? What kind of benefits would that have?
More equity.
Equity, yep.
Equity, cash flow, hopefully cash flow.
Yeah, right.
If you can do the numbers right.
Yeah,
But yeah, equity for sure, so that you can continue to buy other properties to invest in as well.
totally.
The
Yep.
footprint,
What's that?
the footprint of the buyer or seller, whoever's looking to invest in the property, their actual footprint.
Yeah.
Like longer it's there, the more people know you're there.
Totally. Yep. 100%.
Aren't there tax benefits from keeping it long term also?
Yes, there are tax benefits. Of course, Harry, your internet situation just, it really has you, it makes your voice so slow. It like really slow walks it. I know what you sound like in real life. So-
I'm so sorry. I
I'm
was
sorry.
wondering why it was taking so long for anyone to respond.
I know, I feel bad, but I got it. And actually it just broke it up and made it last a lot longer than it normally would. So yeah, definitely tax
Awesome.
benefits. Definitely tax benefits. So I think with real estate, I mean, there's just a lot of tax benefits in general. So that's actually one thing that I forgot to add at the back of this. So I'm glad you said that. It is one of the big things that's a benefit for owning real estate. So totally. Okay, the other types, short-term rental. What would a short-term rental do for you? Typically, like why would someone choose to do a short-term rental?
Monthly income.
Yep. Monthly
You're gonna
income.
earn a lot more potentially, just depending on where it's located.
Yep. Potential for more income for sure than a long-term rental. And the other nice thing, I mean, short-term rental also will, we'll also have that equity aspect to it and the net worth building for sure. Just like a long-term would, because short-term, you're still going to usually keep it long-term, but it's just the way that the rental is set up. So you still should be able to get equity, increase your net worth, all that stuff. So, okay. And then there's some others.
Really quick on that, Nick. Sorry.
Yeah. Yeah.
How long is it? 2 years that you have to own the property before you can start taking out equity? Or is it 1 year? I can't remember if there's a time limit on that.
Yeah, so I don't know. So I don't know that because I would say I don't think there is a rule for it. I think it's just up to the lender because you really can. Some don't do any. Some lenders. Are you talking about a HELOC or like getting another mortgage on it?
Yeah, just like, well, I'm just thinking like in terms of either a HELOC or pulling out the equity so that you can, because generally if you're speaking with an investor, they're going to be investing not in just one property. Usually it's going to be strategic for them to use that equity to get another property. But I didn't know if there was like a time frame because I ran in. So I have like, I was trying to help my brother-in-law with that because he really wants to invest, but they didn't qualify for a HELOC because my sister doesn't work enough. But I couldn't remember because I've never gotten a HELOC out. So I thought that there was like a time limit, or maybe that's just something that I assumed.
I think
I
I
think-
remember hearing the 2 year for the capital gains, if you sell it before the 2 years, that you pay more capital gains tax.
And honestly, like if you're looking at a DTI situation, with getting another investment property, it's your rent has to be seasoned for 2 years if you have an investment property before you can count it against with your income. So that's like the 2 year rule.
There we go. There we go.
Okay, yeah, I
Yeah.
knew there was something about a 2 year. I just didn't remember what it was.
Yeah. So I think it's a matter of qualification, and I think it's a matter of qualification, and it depends on the lender, because a lot of places won't do a HELOC on a rental property. They just won't do them. And then there's a few that will, but they have their own restrictions and whatnot. So I think it kind of depends on the institution. So awesome. Cool. Okay, so let's say wholesale. Who you guys here? But I did added some extras that I think you'll run into. So I'm just like, oh, we'll talk about them. And then we're going to deep dive into each of the benefits and what that looks like for the client. So hopefully by the end of this, we should have a better understanding of all the different things so we can tell them. But I want to go from a pretty high level wholesale. Do you guys have an idea what that is? The more you talk investing, the more you'll run into wholesale stuff. So I just figure I'll give you a heads up on a few of these different, more unique ways. So wholesale, the reason that, what wholesale really means is that you're finding deals on properties that are better than other places. So that's why it's called wholesale. It's wholesale as opposed to retail. So retail would be, they go through, they pay full retail price for an X property, and which would just be whatever fair market rate is at the time. And so that would be retail, which is like what realtors sell properties for, right? We're going to sell it for top dollar. Wholesale means they're going to buy it below that. They're going to get a better deal on it, just like a store would. They're going to pay less for it, and they're going to sell it for more. So wholesale typically means literally the ways that you find wholesale properties, you've got to find sellers that are motivated to get properties sold today. So that's like door knocking, cold calling. Those are probably the best ways. You can also do mailing campaigns. You can do like pay-per-click or like online lead generation to find motivated sellers like that. You can call NODs, the notice of default lists, which I have access to. You guys can call them. And basically those are people who are behind on their mortgages. So anyways, that's how you can find sellers who need to sell now, either because they're behind on their mortgage, they can't sell to a normal buyer because their house is in too rough of shape. But if you find those wholesale properties, then you can sell them to someone else. So like, let's say that I find a property, they're willing to sell it for $250, but it's actually worth $350. Well, let's say they're willing to sell it for $250, but we know that it's worth like $300 as it sits. I can contract with that buyer, with that seller at $250, and I can sell that contract to someone else for $300,000. So I can make the difference, the 50 grand in between. Now, that's a totally legitimate way to do business. There's nothing wrong with it, but it does get, there's just a lot of people who do. There's a lot of people who do seminars who,
Bless you.
Thank you. That was a good one for sure. There's a lot of people who do seminars and stuff about wholesaling that sometimes are not good. So wholesaling is fine. If you find someone who's interested in selling, you work out a deal, you let them know what you're doing. So I even have an addendum you can use that says we're wholesaling it. We are trying to make a profit on it. It's all out in the open. And basically we sell it to someone else who wants to flip it or whatever, and we get to make the difference, but we don't have to have all the risk of actually closing on it, repairing it, all that stuff, selling it. We get to avoid that potential risk.
So when you mean selling the contract, do you mean the listing agreement? Like you're selling a listing agreement to somebody else? Or?
No, it's more like selling the Repsy to them.
Okay.
Yeah. So we literally can contract and say, hey, we're going to buy it from you ish, but we're actually going to sell it to someone else, and we're going to make a spread. Again, it's okay if it's all above board, everyone knows about it, it's all good, it's all right. But sometimes people are basically trying to take advantage of someone and steal their equity, and they don't want them to know that they're not actually closing on it. They want to just take the money in between. So there's nothing wrong with it, but I kind of want you to know that it's out there, because sometimes you can get a good deal this way. You can actually make a good spread on it, and it's a good, sometimes it's a good investment, right? And the nice thing is, so while we're talking about the benefits, the nice thing is it can bring you cash. It's definitely something that brings in income. It's not something that's going to help you long-term with your net worth or help you earn equity, because you're not even going to own the property, but it is a tool. And it's important that you know it. The reason I share it is because it's important that you know it, because people will go to these seminars, they'll be all fired up on it. And then at these seminars they teach, oh, realtors don't know about this. This is not realtor stuff. This is like some underground thing. And so the more you can be a little educated about it and just know how it works, then you can be like, no, I totally get it. I can help you with that. It'll be okay. I've got some clients that I do wholesale stuff for that they love me because I work it out. They make good cash. I make a little cash. It's awesome. So there's nothing wrong with it, but it is hard work. It's not like an easy way out like they sometimes teach at these seminars. So others that I'll just touch on briefly: development. So there's a lot of people who will buy property, who will develop it, whatever that looks like. So they can develop it, like physically develop the property to be able to sell it at an improved value, or paper it is kind of what we call it. Paper it, where you can literally help them buy the property. They buy the property, and then you run it through the city to have it all subdivided, turn it into a whole subdivision or whatever, and then sell it as individual lots. You can make a lot more for individual ready to go lots than you could for just the dirt that was there.
So I have a question about that.
Yeah.
With developing properties, so when you say you buy like 1,400 acres and you want to develop it into a neighborhood.
Yeah.
So with that, would you have to build each of the properties yourself with your own money, or could you work with a builder and then have them just like split the cash with you after it's built?
Totally. Yeah, you could do any of those. So yeah, you could do that. Most of the time, like, I'm not a builder, so I wouldn't do that, but I would partner with a builder, and then they could either buy the lots from you, or if you partnered on it, you could take a piece of the profit or whatever. Yeah. So I'd say most commonly, you buy it, someone turns it over into a neighborhood, and then either they sell the lots individually to builders, or they sell all the lots to a builder who then sells each of those units. Exactly. Yep, exactly. So that's probably more common. So that is an option. The nice thing about that is, that's going to bring cash, because we're improving the property and we're going to increase our cash, right? So there's a difference between building cash flow and increasing our net worth. And then the last one, which this is, I think, kind of what Carly was alluding to at the beginning. BRRRR. You guys have probably heard of the BRRRR method. Ever heard that? Someone probably on here knows that, right? What does it stand for?
Like BURR?
No, it's BRRR. We'll see if I can get it right then. Okay. So it's like a test. So buy, rehab, refinance, rent. So buy the property, rehab it, fix it up. So you're getting a house maybe that's not in the best shape. Buy it, fix it, refinance it. So then you can refinance it, which is going to get you, a better rate, better term, something like that.
To give it to Mike.
Does it have your info on it?
Yes, it does.
Will you just put it on that desk? I'll make sure it gets there. Yeah, totally. No problem at all. Okay, so buy, rehab, refinance. So the reason that you refinance is because normally you're buying a property that's in worse shape than can be financed. So one of the issues with buying a property that's not in good shape is lenders don't want to lend on it because it's not up to par. So when the appraiser comes through, they're going to say, geez, the roof was bad, there's leaks, there's issues. So all these problems, they're not going to loan on it because they don't want to be responsible for that property. So basically, that's why you end up refinancing it, is because you've already fixed it up. Now a normal lender is going to be willing to pay for it. And then you rent it. So you refinance it, which is going to get you a long-term 30-year payment that's reasonable, and then you rent it out. So that's a way you can get a little better rent that way, because you bought it cheap, you put in some money to fix it up. Now it's a nice property, so the rent is going to be more. You're gonna have a 30-year loan on it. It'll be great. So BRRRR is a great method to buy rental properties, and probably the easiest one. And then we're going to go into the details of some of the different benefits, is what we call house hacking. To be fair, I don't really love the name house hacking, because it's kind of just house buying. It's like normal house buying, but I guess I don't like things that are too that people have been saying over and over for the last 15 years. But house hacking is basically just buy your own personal properties. So you go buy your first property, you rent it out, buy another property, rent that one out, buy another property. It's for sure the easiest, cheapest way to invest in real estate, I would say, because it's easy to buy a personal property. So if you're going to buy a personal residence that you're going to move into, they're only going to charge you, or you only have to bring, say, 3.5%, 5%, 10% down on that property, so it's really inexpensive, and you can qualify for it just based on your normal income. So it's really easy. As long as you have normal income, you're good to go. So that's really, house hacking is the one that I'm talking to a lot of my clients about, because even if they're not big time real estate investors, if they want to build wealth through real estate, and the way you can find out if they want to build wealth through real estate is just say, hey, have you ever considered building wealth through real estate? You ever had a desire to build wealth through real estate? Like, that's all it has to sound like. But it's one of the easiest ways to do it. Because if you go to buy a long-term or a short-term rental or whatever, you're going to have to put down 25% probably. There's some banks that will go as low as 10% down, but it's much harder to get it's much harder to come up with the cash for an investment property than it is to buy another primary residence. So anyways, on that front, if you're talking to an investor, ask, hey, what are your what are your goals? What do you want this to do for you? Why do you want to invest in real estate? If they say they want cash, you're going to be talking about a flip. You're going to be talking about a short-term rental. You're going to be talking to them about maybe development or something like that. If they want to build wealth through real estate, like they want to build their net worth, they want to grow their portfolio, then we might be looking at long-term or even short-term. We might be talking about doing BRRRRs. And we might be talking about house hacking. So
with house hacking, like they're buying a primary residence and then later on renting it out. How long do they have to hold it as a primary residence, and do they have to like actually live in the property, or?
Yeah, so they do have to live in the property. They have to intend to live in it for a year, and we're talking like federal regulations are that to get a property like that as your primary residence, you have to intend to live there for a year. That doesn't mean you have to actually live there for a year, but it means you have to intend to. And there's a big difference between saying you intend to and actually intending to. It's like, you don't have to live there forever if something changes, but that has to be the intention. So if something changes dramatically and you don't live there for a year, it's not going to be an issue, although it may be an issue for you to get another loan within that year. So lenders are not going to be big on getting you that loan. I think it's actually in the guidelines. If it's not, then it's certainly an overlay that a lot of lenders have. They're not going to give you another loan until that first year is up, because they don't want to help you just amass this huge rental portfolio without following the guidelines, right? So anyway, so that's why you do it, but it's hard. Like in my position, like, it's hard for me to do house hacking because I have like a decent house that I like, my wife likes, my dogs sure like, and it's like, we're not going to move. We're not going to
every year. Yeah.
We're not going to move every year. Like, we like it. So the house hacking one is really good for younger people. Whenever I meet with younger people, especially younger single people, I'm just like, you have got to buy something. You've got to buy something a little bit less than what you want. So you don't need the biggest, nicest, fanciest house in the world. You just need something. You need to have your own little slice of real estate, rent it out with friends or whatever, and then buy another one in a year. And that way, if you start with a condo or a townhome or a small single family or whatever, and you can upgrade kind of as you go. But, if you did that for, if you bought a new house every year for 10 years, your finances would be so different than the average person, right? So if you in 10 years own 10 houses, that you only put 3.5% or 5% down on, not a high amount. Plus, you could probably you could be borrowing some from the first few properties to buy the other properties. Like, it would be a huge life changer, right? And we'll go through why that would be such a big deal. But I put a lot of pressure on young people to be doing that, to be building their wealth. Okay, perfect. So does that kind of make sense? I mean, I didn't go way specific, but when you're talking to them now, hopefully by going through those benefits, you can get an idea of this is what might be the best fit for you in this situation. If you're looking to get cash, we're going to be doing flips. Or short-term rentals, maybe. If you're looking to build net worth, you might be doing long-term or short-term rentals or something that you can hold on to forever, because you're going to get that appreciation long-term. And I'll show you kind of what that looks like. So up to that point, any questions?
Yeah, so I have seen people who will do it with lease or like seller financing.
Yeah.
And they'll basically have the seller agree to seller financing and agree to lease it out, and then they'll lease it out to people and never actually pay any of their own money. Do you suggest people to do that, or is there like risks that come with that?
I mean, seller financing as a whole, the renting it out probably isn't a problem. Unless there's restrictions against rentals in that particular area. Yeah, but no, that wouldn't be an issue. But seller financing as a whole is just, I think it's a good deal for the buyer. I think it's risky for the seller in a lot of ways, but I think it's a better deal for the buyer. But it's also risky for the buyer because typically you're going to have to put a fair amount of cash down. And yeah, I would totally do it. Yeah, if you got a seller finance deal, bring it to me. I'll do it today. But yeah, I think it's a good deal, but there are definitely some concerns with it. Some things you have to know, especially when if you're doing it yourself, it's one thing. If you are helping a client do it, you really have to make sure, whether they're the buyer or the seller, there's these huge risks involved, and you have to make sure that it's fully disclosed, fully understood, everyone's on board, because this is the risk to buyers. The risk to buyers is they put all this cash down. If they don't make their payments, they lose their down payment. However, that's also like, what other situation does that happen in? Pretty much anytime you finance, right? You don't make your payments, you lose your interest in the property. So that's not too much different or too risky. But for the seller, it's a little different, because the seller is going to have all the risk of, if this buyer doesn't pay, they're going to have to take the property back. But if the buyer does pay, they won't be able to take the property
And they
back.
can't even come visit the property. It's not like a landlord situation, right?
No.
Okay, yes, for sure.
So it's a little risky, because if the market, let's say the market goes up a ton, the landlord, or not the landlord, the lender, the person who sold the property to the buyer, right? They don't get to say, oh, the property values went up, I want to recapture some of that increase, right? However, the market dips down, the buyer walks away because now the house is worth less than it was when they bought it. They walk away from it, the seller is going to take possession of it. So there's risks that the seller incurs on those that normally only big banks incur, which big banks have plenty of cash, and well, in some cases, I guess. Anyway, so it is kind of risky for both. It's okay as long as everyone understands it. It's fully disclosed. It's all good. So any other comments, questions? Okay. All right. So now we'll go into some of the numbers. So I want to show you. So I wanted to be able to monetize what this looks like for our clients. So obviously, one of the big things about owning investment properties is cash flow. And that's the one that I think they look at the most. That's the one that's hit the hardest because of increased interest rates. It's hit the hardest because it's reducing the amount of cash flow, because it's increasing the cost to the owner, and it's not changing the price to the tenant. So it's reducing that spread. And by the way, it's been hard to make those profitable for years. You know, that's not really anything new. So, you know, but there used to be the 1% rule. There still is the 1% rule that the rent should be 1% of what the property's value is. So if the property is worth 300,000, the rent should be $3,000 a month. Now, does anyone know any deals like that where a $300,000 house is renting for $3,000? Not for me. I don't know. I don't know of any of those, right? So it's probably a $600,000 property that's renting for $3,000, right? So, you know, but if you read any investment books about that, they're going to talk about the 1% rule, which is fine. It's just in today's world, that's not really a
So
thing.
would you say like a 0.5% rule then?
That'd be great. Yeah. Yeah. And ultimately, it depends on what's going to work for them. So your client, what are they looking to get? If it's only cash flow and they're not making hardly any cash flow, it's not going to look like a good deal to them. So that's where we can kind of wrap this in and say, hey, it doesn't maybe feel like cash flow today. It's not cash flowing great. There's not a bunch of cash being thrown off of it, but it is self-sufficient. And 30 years down the road, look at all the appreciation you're going to be able to take part in. And we'll talk more about the appreciation, but specifically about the cash flow. You know, for an investor, obviously it's the difference between what they're going to pay versus what they're going to be paid. That's how they're going to figure out what their cash flow is. Now, there's a couple things to keep in mind with investors. They're going to look at a cap rate a lot of times. So who knows what a cap rate is? How about anyone on Zoom? Someone does, because I think they talk about it in real estate school, right?
Maths. I'm really bad at math, so I need to start getting better at it.
You're like, let's not talk about any of the formulas from the real estate school. Okay, so cap rate is net operating income divided by property value. So whatever the net income, meaning after the basics are paid, what is the income of the property going to be? And then divide that by the property's value. So I just ran a quick one, and this isn't really, that's not actually probably accurate. Let's see. Because like my assumption was not very good. So let's say a $500,000 house. Let's say that the income that it's getting is 2,500. Maybe let's say 2,000 is the net. So every month, hold on. So let's say, because this is annual. So let's say annual. Okay. So let's say that the property has a net operating income of $1,000. So it's cash flowing $1,000 a month. So multiply that by 12, of course, it would be $12,000. When you divide that into 500,000, which is the price of the property, it's 2.5%. So 2.5% cap rate is what that would be. Now, more than likely, you're probably going to have more net operating income on a property like 500,000. Let's say you're going to get 2,000. So maybe that would be 4.8%, something like that. And that would be pretty normal. Like around 5% is about normal for a cap rate. One thing to keep in mind, cap rate does not take into consideration the debt service. So whatever the mortgage payments are, or if you're buying it with a HELOC or something like that, that's not included in this. So the cap rate is nice because anyone can look at it and it has the same meaning to everyone, rather than, if one's financing and one's paying cash, then it would look a lot different if you were including the mortgage payment in it, right? So anyway, so cap rate is what you'll see. People will put that on the MLS. If it's around 5%, that's about average. So most people, for the most part, you're not going to want to go buy a bunch of 5%ers. You want to buy 6, 8%. If you could find a 10% one, that would be great. But that is only one way of looking at it. You also have to actually calculate all your expenses with your mortgage, with your taxes and insurance and all that stuff, and make sure that's a good deal that cash flows for you. But that's how an investor would look at it. And some of the stuff that's going to go into that calculation is going to be Of course, you got your potential rent. So how much can you actually rent this place out for, minus your vacancies? So, okay, we're not going to have it rented out 20, 100, 365 days a year, probably not. So that's one thing that you'll look at. And then the other things are management fees. So if you have a property manager, taxes, insurance, maintenance on the property, those are all things that people tend to leave out of the equation, but those are all included. You have to pay for all that stuff. So, and a lot of people, they won't count property management because maybe they're not going to get a property manager. They're going to do it themselves, which is fine. But long term, when you're evaluating a real estate deal, you want to evaluate it based on, if you weren't being the property manager, what would that look like? It's like if you sell a business, like let's say I sold a business, like let's say I sold my real estate business. People aren't going to want to buy it for what the income, for just like whatever my income is, because I own it, but I also operate it day to day.
Adding value.
Exactly. So it's like they don't want to pay what I'm getting paid for it, because they're gonna have to buy that business, plus they're gonna have to hire someone to run that business. So they're gonna want to pay less for it, so that even after they hire someone to do all that work that I would normally do, it still makes a profit for them. So same thing with real estate. You want to base it on, okay, if we go totally passive, because who doesn't want passive income, right? So real estate is meant to be a passive, at least, long-term real estate is meant to be a passive income source. So you want to know what it looks like to have it be running as a passive business. And then maintenance, of course. One thing is when you're dealing with investors like this, and I mostly want to model, this is the conversation you're having with your clients. So you're going to teach them what I'm teaching you guys. They're going to want to have reserves. Right. So they need to have reserves. So what we normally say is either 3 to 6 months of expenses for each property that you have. You want to have reserves for that, or 3 to 5% of the value. And those are usually going to be pretty similar numbers. But basically, 3 to 5% of value is usually, let's say it's $500,000 house. That means you want $15,000 to $25,000 in reserves, which makes sense because you're going to have roofs and furnaces and vacancies and all that stuff. So you want to make sure you've got that all padded in there. So same thing with the homeowner. The homeowner needs to have similar reserves to that to make sure that they can afford to own the home, right? So let's flip it. So talking about cash flow, if you're a homeowner, sometimes it's hard to see the cash flow side, because the homeowner is the one that's going to be paying the payment, right? So it's a little different. So the cash flow benefit to the homeowner is that they have fixed mortgage for 30 years. So they've got a fixed expense for 30 years. That's mostly true. Of course, it can be adjusted based on taxes and insurance, right? So you guys know that your mortgage payment can move a little bit based on the taxes and insurance. So, and especially in a market that's been moving up in value for the last several years, we've had our taxes just increase, pretty consistently at a pretty high rate. So that does bump our taxes up a little bit. But for the most part, our mortgage expense is fixed for 30 years. At least our principal and interest is fixed. So that saves you a lot. So I ran a little scenario. So I found out that since 1980, the average annual rent increase is 8.86. That's a lot. That's really high. So anyways, based on that 8.86%, I just kind of ran it. So let's say you buy a house and your mortgage is $2,000 the first year. Let's say that your rent was also $2,000 that first year. So you kind of broke even, right? Probably the first year, the rent was even a better deal, because if you paid both the same, but as a renter, you don't have the responsibility of repairs and all that stuff. It was probably cheaper to rent than it was to buy. But each year it's going up 8.86% on average. So as you see that, so the second year, so the first year it goes up and it increases to, no, that's kind of weird. Okay. Oh, I know why. Okay. First year it goes up to 2172. So you go from 2,000 to 2,172. So just after that first year, now you're saving $172 by having a locked in mortgage, right? And I thought I did each year separately, but I kind of didn't. The next year it's going to go up again by 8.86%, but I calculated the total savings for the whole year in each of the first 5 years. So the first year you wouldn't save anything. The next year, the first year after that, you would save 2,064 per year, right? So that's at 172 times 12 months. You're saving 2,064 for that first year, is what your saving is over if your rent was to increase. The year after that, you're saving $4,305 each for that year. The third year, $6,739 per year. The fourth year, $93.83, and the fifth year, $12,252. That's your annual savings of owning a home just because your mortgage didn't go up. Let's say a little bit of that gets eaten up by property taxes, but because property taxes went up a little bit, I'm sure, in that time, but not to the tune of $12,252. That's not in Utah, maybe in like Texas or someplace where they have crazy high property taxes. But anyway, so is that a pretty big, to me, that's a pretty big deal, right? So that's a big deal. So that's a lot of times when I'm talking to clients like that, they're expecting me to say, hey, it's way cheaper for you to buy than to rent. And they don't feel that way. They don't really believe that all the time. And sometimes it's not true, because that first year it may not be, but over time, it gets to be a really good deal to be owning rather than renting. Does that make sense to you guys? Like, I haven't seen anything from Zoomland in a while. I just want to make sure we're connected. We're good.
Yes, sir. I'm still with you.
Cody's still
Yep,
there.
yep.
Okay.
Makes sense.
Heck yeah. Okay, good. Good. Okay. Yep. So there, just that one thing alone, like I said, cash flow for an investor is dollars that they're making each month. Cash flow for a homeowner can be dollars that they're saving every month or every year, right? So that's a conversation we can have with them. And I put this together. So after 5 years, the mortgage payment so after 5 years, the rent that was 2,000 is now 3,021. After 10 years, it's 4,563. Like, it just gets crazy, right? So, and that's the average since 1980. So, anyway, so there's a big difference there. So whenever you're dealing with a buyer, you want to take things long term. So they're just like, hey, do you think interest rates are going to go up or down? Do you think house prices are going to go up or down? As long as you take it, if you go short term, who knows? We don't know what it's going to look like this year or next year. But if you take it out 10 years, does anyone believe that house isn't going to be worth more money? Like, it's just never happened, right? At 10 years out, it's going to be worth more money. Not to mention, they're going to have paid off a ton off of that mortgage. So now they're going to have a much higher equity position in it. It's like, you always want it with buyers, you want to take it long term and show them the value of being long term. So, any other comments or questions on the cash flow side of it? Okay, cool. Well, let's talk about something else then. So, okay, so let's talk about appreciation. So when we say appreciation is the thing that is really going to benefit your net worth by owning real estate. So your net worth rises obviously because your assets increase. So your net worth, I love when people talk about running your net worth statement, figuring out how much you are worth today. Sometimes, if we were in like a budgeting seminar, we'd be like, hey, it might hurt to look at your net worth, right? It might hurt to look at all your, of course, your net worth is everything you own minus everything that you owe. And so, but it's important to look at it because you can gauge the progress that you make financially. Whereas day to day, it's harder to do that. So I love looking at net worth trackers because you can really see where you're making good decisions or bad decisions. So it's cool to watch how the needle can turn. But anyways, your net worth is going to be impacted by appreciation because as you own these properties, they're going to be appreciating in value, which is literally they are bringing you money. So it's like this podcast that I listen to. Now I can't think of the name. Money Guy, probably heard of it. Money Guy, but they always talk about your little army of dollar bills. So they're talking about retirement. You want to save up a bunch of money, put it in different investments, and that's your army of dollar bills that wake up every morning and go to work for you. Right. So you're raising an army of dollar bills. That's kind of what your homes are. Your homes are it's your army of dollar bills that's going to work, appreciating for you every day. Right. And so appreciation, a pretty conservative number for appreciation year over year is 4%. So we've had a lot of years that were higher than that. Probably not very many that were lower than that, but we do have some that are negative, not very many, but some years that are negative, right? So the average, let's say, is 4%, which is super conservative. So a $500,000 house that's increasing in price at a 4% rate after 5 years is going to be worth $608,000. So this is all just stuff that I kind of calculated up. I just ran all the numbers so that I could show people. And I think so over 5 years, it made $108,000. So, you didn't have to go to work. You didn't have to do anything. You do have to make your mortgage payment. You got to make that anyways. You got to either pay rent or mortgage or whatever. Right. So, but after 5 years, it grew by $108,000. That's huge. Right. After 10 years, that $500,000 house, was worth $740,000. It's a big deal. And then after 30 years, 1.62 million after 30 years, which by the way, after 30 years, you may not owe any money on it, right? So that's just a huge deal. So that's the appreciation. So if you say, someone says, hey, if you explain this, if you show these numbers to someone and they say, hey, I think we're going to wait. Awesome. So based on these numbers, what makes you want to wait? Why don't you want to get in and take advantage of this? Like, what's holding you back from taking advantage of the appreciation that the market has to offer you? Oh, well, I don't know what this year is going to do or the next year is going to do. Yeah, I don't either. But let's take this out 10 years. You're going to be so happy that you own this property. There's never been a situation where 10 years down the road, you didn't wish you bought more real estate rather than less real estate. It just doesn't happen, right? It's a no-brainer. So that's kind of what it sounds like, to extend that timeline out and just say, hey, 10 years down the road, you're going to thank yourself for doing this. And there's proof for that everywhere. Because how many of us have ever said, oh, I wish I wouldn't have sold that house, or have heard someone else say, oh, I wish I wouldn't have sold the house, right? Wish I would have kept it. And how many times do we say, oh, I wish I would have never bought the house. I wish I wish I never bought the house. I'm so glad I sold it when I did. Like, people don't say that. That's just not how real estate works, right? So long term, you want to own more real estate, not less real estate, for sure. So that's just general appreciation. The numbers are just huge on it. And it's also the most consistent. It's just conservative, little by little every single year. There's also, if you flip it, like if you were to compare real estate investing to investing in the market, it's wildly different because of the fact that we can leverage real estate, right? We can get a mortgage on it for a pretty inexpensive amount. So, because you can also talk about the cash on cash appreciation or the cash on cash return. So your $500,000 house is worth 608 after 5 years. So that's going to be like, I don't know, 25%. Yeah, I guess. Well, more than 20% increase over 5 years. But if you compare that, so it went up $108,000. How much do you think you put down on a $500,000 house?
Probably not much. Probably 10-15,000.
Not too much, right? It's so I ran, let's see, okay, 3.5% down on a $500,000 house is 17.5. So if you paid 3.5 down, which would be like an FHA loan, you paid 3.5 down, that's 17,500. And after 5 years, it brought you $108,000. That's like 5x. Well, more than that. It's probably like 6x or something. So that's huge. Oh, I put the percentages. It's 114% per year increase. So that's like 600% over 5 years. It's crazy. If you put 5% down, that would be $25,000. That's an 80% return each year. That's crazy. I mean, what investment returns 80% a year, right? Especially consistently, like real estate does. Long-term consistently. And then if you put 25% down, so let's say that you weren't buying it FHA and you weren't buying it 5% conventional. Maybe this was just an investment property, so you weren't moving into it or anything. You had to put 25% down. Let's say you put 25% down. That would be $125,000 that you put down on the property. And after making $108,000 after 5 years, that's still a 16% return year over each year. 16% return, that's higher than the S&P 500. That's higher than any traditional investment you could come up with. So anyways, that's the other thing, is appreciation is going to increase, which is going to increase your net worth by tons. Like, it's just going to hugely change your net worth. Now, I don't have the exact number. I do have the general thing because I had it pulled up on my phone. But basically the average, so this was, so in 2019, the average net worth for a renter is $6,270. And the average net worth of a homeowner is $254,900. So the general rule is that it's about 40 times. I don't know if that's 6,000 to 254 is it's a lot of times. I don't know. I guess 10 times would be 60 grand. It's 4 times that. So yeah, about 40x what a renter's is. And if you just say, hey, homeowners are worth 40 times what a renter is, sometimes I think that's such a big gap that it's not believable or something, right? But if you can show them, hey, here's what appreciation does for you. Not only it's 40 times higher, but let me show you what that appreciation looks like over 5 or 10 years. Then it's like, oh, it's not just a number on a paper. It's like, oh, that's how it gets there, is do that appreciation, right? So anyways, any comments on appreciation? What that looks like, why it's good for our people?
I mean, understandable, because as a renter, I continually have to pay more. So it's like, I think when I first started renting apartments, it was like $750 a month. Now I'm at $1,750, so it's like a whole it's a nightmare.
That sounds right. So yeah, and that's why getting into real estate is awesome, because we get to help people do this, and we get to do it for ourselves and build wealth for ourselves. It's awesome. So cool. Yep, appreciation is huge, and it's just one of those things you just have to get in, and you have to wait. It's not always sexy. Probably the coolest thing that I learned from so David Earnhardt, I don't see him a lot, but he's out of our South Valley office, and we were at this convention in Dallas, and we just saw him at this little restaurant. He was sitting by himself. So me and my friend, we went up and just started talking to him, and he's a big investor, and he has a lot of investing clients. He's just super cool guy. And we just took notes. He just talked to us for an hour or two, and we just took all these notes of all the things that we learned. But what the main thing that I learned, like the thing that I took away, and the thing that I think we need to tell our clients, is he said, you don't need to get a grand slam. You just got to get on first base. It was like, because I think, at least in my mind, I want the best deal ever. I want this property that's going to cash flow like crazy, and it's going to increase in value like crazy. And it's like just this totally abnormal deal. That's what I want. But because of that, I don't buy on certain deals, because I miss out on deals because I want the perfect one. And then I let 2 or 3 years go by and look at all the money that costs you, right? And so that one little piece of advice, you don't have to hit a grand slam. You just want to get on first base. So get a property, get another property. One cash flows a couple $100 a month. One barely cash flows at all, but as you go, you're just going to start appreciating all these properties, and it's going to increase your net worth like crazy. So anyways, that's kind of what I got out of appreciation is your friend. So okay, the other thing, and this kind of has to do with appreciation, but it's kind of the flip side of it, is forced savings or principal payoff. So one thing is, and this is more, I guess, probably one that's harder for us to deal with, because it's more behavior. It's something that modifies our behavior. Mathematically, it's not way different, but it does change our behavior. So forced savings just means we have to pay that every month, right? And because we pay that every month, it reduces our principal amount that we owe on the property. And because we owe less on the property, we now have more equity in it. We have more net worth, right? And so some people would call that forced savings. It's money that we did have to pay, but because we were forced to, because we have a mortgage payment, it helped our financial situation, right? Whereas otherwise, if let's say we ended up with an extra $500 in our bank account, we might have just gone and spent it, right? And of course, we would all be like, no, we won't, we'll invest it. But let's be honest, probably would have spent it. So at least in my case. So anyway, so forced savings is a big deal. It gets us, we're actually paying off that and increasing our net worth. So one thing, let me just read this real quick because I put all these calculations in here so pay rent for 30 years. Oh, okay. So this was just saying if you pay rent for 30 years, at the end, what's the asset that you have? It's zero, right? So, and some people say, oh, I don't want to throw money away on rent, which is fine, but it's not, you got to live there. So it was, it's valuable, but you didn't end up with anything. You pay a mortgage for 30 years, let's say it's the same amount or probably less now because we know rent's going up consistently, right? So pay a mortgage for 30 years based on that initial thing that we went through of the value of a $500,000 house. Now that house is worth 1.621 million. And now you own that house free and clear. Where with rent, you had $0 at the end of that. I think that's crazy. And then, okay. It's smaller than the appreciation, but it's still a benefit. So when we're talking about the forced savings, let's say on a 30-year loan, and I ran these are real numbers. So $500,000 house at a 7% interest rate, the payment is $33.27. Payment is $33.27, and $410 of that goes to principal. And that's 12.3% of your payment. So on rent, none of it goes to principal, right? There's not a principal to pay down. So, but if you're owning this house, 410 goes towards principal every month. And that's just month one. Month two, even more goes because it increases as you go. But you start out 12.3% of your payment goes to principal. After 5 years, I didn't do more than this, but after 5 years, you paid off just under $30,000, about $6,000 a year that you've paid off just by paying your normal mortgage payment. So that's another 30,000 over the 5 years. So that's another $6,000 a year that you've added to your income, basically, or at least saved yourself $6,000. That's crazy, right? So you can add that to the appreciation, add that to the cash flow or the amount that you save year over year. It's crazy. And then the last one is tax benefits. And to be honest, that's changed a lot over the years. And I'm not a tax expert. I'm honestly the worst with taxes, like literally the worst. I don't like to deal with all that stuff. But when it comes to tax benefits, it used to be a little more beneficial as an individual homeowner. It used to be a little more incentivized to own a home because you would write off all of the interest that you paid for your home, right? And the truth is, the public still thinks that's the case. For most of us, that's not really the case because the exemption that we get, whether you're single or married, is pretty large. And I can't remember, honestly, I haven't looked at it in a while. I can't remember if it's $12,000 or $24,000 a year, something like that. But maybe it's 12 single, 24 married. I don't know. But most people take the standard exemption rather than itemizing all their deductions because it's higher. So anyways, there's not as many benefits in that sense to a normal homeowner, but there's a lot of different perks. There's obviously a lot of different things that you get for being a homeowner. So there's a lot of things on the tax side. You may not get as much of a break as as we used to compared to everyone else, but it's still a good deal. Now on the investor side, what's the benefit? And check with your accountants. See if you find out some great deal that homeowners get on their taxes, tell me about it so we can pass it on to our clients. But from what I understand, it's not a huge benefit these days. But we don't have to tell our clients that. We don't have to say it quite like that, right? But anyways, for an investor, the tax benefits are pretty big, because if they go invest in something else, they may have to pay taxes on it, every year or whenever they realize those gains. But with real estate, it's nice because you can do 1031 exchanges, right? So I guess I should say actually, I should back that up. Let's say if you're a normal homeowner, if you own your home for at least 2 years, it's your primary residence, and you go to sell it, you can basically qualify to not pay any taxes on that, right? And that's not deferred taxes. That's just taxes that are not paid. You never pay those taxes. So,
And is that because you're never coming in contact with that money and it's just going straight to another?
it's not, surprisingly, and this I think is commonly mistaken. I'm not a CPA or anything, but it's still true. So if I buy a house, let's say it's $500,000, after 4 or 5 years, I sell it for $750,000. That $250,000, I can take that as cash. I can deposit directly into my bank account. There's no taxes. Now, if you're single, you can do that for up to $250,000. If you're married, you can do that for up to $500,000. So that's a huge benefit. So when I say there's not tax benefits, that's not really true. I'm thinking annual tax benefits. When it comes to when you go to sell it, that's a huge benefit, right? That cash can go in your pocket. It's not income. It's just not. When you go to the title company, they won't file a 1099 for it or anything. Now, so that's pretty cool. Now, if you haven't lived there for 2 years, or if you used it for business purposes, or if you've ever rented it out, or if you have done this with one of your primary residences within the last 5 years, then they're probably going to report it to the IRS. Not saying you have to pay taxes on all of it, but you'll probably have to pay taxes on some of it based on all the numbers. You'll have to talk to your specific accountant about that. But anyways, you don't have to. You get exempted on a fair amount of that money. Now, what you're thinking of is 1031 exchange. Now we're flipping over to the investor side. So investors do 1031 exchanges, not individual people on their homes. 1031 exchange is not, it's not that you don't have to pay the taxes, it's that you're deferring the taxes. So you're pushing them down the line. And a lot of times people don't pay tax on it ever, because when they pass away, their estate gets the property and isn't taxed on it. And that depends. There's a lot of policies around that and whatnot that will determine whether that's still the case or not. But at least through your lifetime, you can use the 1031 exchange to defer the taxes through your lifetime. Hopefully you could shield them for your family. And if not, at least until you're dead, which that's a good long time period, I feel like. So anyways, you can kind of defer that. And 1031s, it is something that we run into a lot. We can help our clients with that, but it's one of the tax benefits because you really can keep deferring it. And all you have to do, there's a few guidelines. This isn't like way specific. I'm not like the pro at 1031, but we do plenty of them. But basically the property that you sell, you have to have some 1031 paperwork signed with the sale. And then the house that you purchase, you have to have 1031 documents on that. And in that case, the money can't ever touch your hands. You can't ever come into contact with it with any of your accounts. It's very specific. It's not complicated, but it is a specific way. So when you sell the property, you sell it, we get a 1031 exchange company involved. And what they do is just escrow it so that it never touches your accounts. They escrow the money that you get and they put it towards the new one. And the rules are that you have to double check me on this, but I only looked it up like 3 days ago. So I imagine it's still legit. You have to, from the moment you close on the sale of your property, you have 45 days to identify the new property. So you have to have in writing, probably you have to have a contract. I've never cut it this close, but you have to have a contract within 45 days, or at least have identified that's the house we're buying with this money. And then you have 180 days to close on it. So 180 days to close on it. And then that money that's being escrowed will move over there and you'll never touch it and you'll defer the taxes on it. So that's kind of how it works. It's something that's good just to know about, you know, with our clients, it's good to know that that's an option. We can help them with that. We just had a client who didn't know about all that. Well, not a client. Saying it's a client is not really true. Someone who did it without realtors, who did a 1031 exchange, but they didn't do the correct paperwork. They didn't use an escrow company. They did take the funds, hit their account. And that's so they didn't hire a realtor, and it's gonna cost them a lot of money.
Tax money.
A lot of money. So anyway, so it's a way that we can add value to our clients and basically show them. So one of the benefits is their tax benefits, and most of those are going to be when you sell it. If it's a primary residence, you can shield a lot of it. You know, 250 as a single person, 500 as a married couple, or if it's an investment property, you can't save that money, but you can defer it. And in some cases, you could defer it indefinitely, which is pretty cool. And one thing I'm not saying this is 100% true, because I'm really not like an attorney, accountant, 1031 pro, but I'm pretty sure that, like in real estate school, they always said it has to be a like kind transfer, right? And from what I understood through real estate school, that was like, okay, single family home to single family home, or duplex to duplex. And from what I've seen through 1031s, everyone says that's not how it works. It's like kind means real estate to real estate. Now, I'm not saying there's not two pieces that are so different that you wouldn't fit it in that category, but I've seen people do 1031 exchanges. Again, I'm not saying it's 100% accurate, but I've seen them do it on from residential to commercial properties, from like, if it's real estate, you could pretty well transfer it. So reach out to the CPA CPA, attorney, whoever's involved. Make sure that you're all good and everything before you're risking this amount of money. But I was surprised to find out how loose it was as far as what a like kind was. Because I feel like in real estate school, at least for me, they're just like, it has to be like very similar,
Yeah,
you know.
house to house, rather. I mean, if you could change it from house to a triplex or something, that's a huge deal.
Totally. And then change that to an apartment building,
Yeah, that's
or
crazy.
like, and that's everything that I've seen says you can do that, which was surprising to me. So anyway, so those are the tax benefits. So these are the big four benefits: cash flow, appreciation, principal reduction, forced savings, and then your tax benefits. So anyways, those are the big things that we could talk to people about. So whenever they get pigeonholed into cash flow, we can say, hey, totally understand. Let me show you some of the other benefits, and even pull out a calculator. Maybe get good at just running these. I can send you, so here, I'm going to take a quick picture, because this is not going to be formal. Because if you saw the numbers that I ran, it's literally just scribbled on my thing, but I can send this to you. I'll send it to you just so you have it. But get good at doing this, and maybe even make a fake version of it. Like make one that looks nice that you can give to your clients that says, hey, you know, to be fair, I'll try to do it. I just can't guarantee when I'll have this all put together and all pretty. Because I would like to be able to offer it for you. I just don't want to overpromise that, because I don't know when I'll get to that. But if you could sit down with your client when they say, hey, why would I buy a rental property that doesn't cash flow, or that doesn't cash flow a lot? You can say, hey, I totally understand. And today that's true. Let me show you what that's going to look like over time. You can show them the increase in rent, how that's going to increase their cash flow. You can show them the appreciation over the next 5 or 10 years. You can show them the amount that's going to be paid down. I mean, then of course, there's also the ability for them to borrow against these properties to buy more properties, right? And leverage that way. So anyways, there's a lot of benefits to owning real estate in the US, probably all over the world, but specifically in the US, there's a lot of good ways to do it. And so I'm grateful for that. And I think it's a cool thing we can help our clients do. And one cool thing about being in real estate is we get paid in chunks. So we can help clients buy and sell investment properties, or buy and sell their personal properties. And then we can use those commissions and we can put them down on real estate, you know, which I think is super cool. So anyways, what comments or questions do you guys have about that? Is that helpful? How about, or ahas or anything?
No, I think it's super helpful. Just rolling it all in to build your portfolio at the same time as helping your clients and then having repeat customers. It's just gonna keep building and building.
Heck yeah. Love that.
Yeah, I feel a lot more confident. I feel like a lot of it in my head was like, when's a good time to buy kind of vibe. I'm sure a lot of clients, I haven't really dealt with a lot of clients yet, but I'm sure that's a question that a lot of them ask too, is like, when's the best, is it a good time to buy? And it's like, this makes it to where it's like any time is really a good time to buy.
Totally.
And the longer you wait, the worse it gets. So
Totally.
mhm.
Yep, 100%. Yeah, one thing, I don't know how many of you guys know Boyd Brown. He's awesome. He's operating principal for our offices, just great guy. But he just always, he said, like I've been in classes where people have asked him, hey, he's a big investor. He invests in lots of things actually, but so some people have asked him, hey, when's a good time to invest in real estate or whatever? He's like, buy a house this year. If prices go down next year, buy a house next year too. It'll be on sale. If it goes up the next year, buy a house then too. He's just like, you just need to constantly be buying properties. Don't worry about the ups and the downs. Keep buying real estate. It's just like, honestly, it's not that much different from investing in stocks or anything like that. You just buy every year you buy. When you buy it and prices are a little higher, maybe you don't get as good of a deal. When you buy them lower, you're getting a better deal, but no one knows when all that's going to happen. Just consistently buy. Like everyone says, when it comes to retirement, the size of your retirement has to do with
When you start.
yeah, when you start and how much you're consistently putting in. Like the rate of return is great, but if you're not investing, it's not going to be growing. There's not, it's all about your contributions that you put into it. So anyways, I think it's fun to help clients build their real estate portfolios, especially normal people who like have normal jobs, like, plumbers, electricians. They're some of my favorite clients because they have great incomes, but they don't really have a way to get wealthy through their work, right? They can't work double time and, make all this extra money and build wealth for their family. Like, but they're great at what they do. They've got a great income. They can qualify for property. They probably have some cash. Let's help them build wealth. They can do what they're good at. Whatever trade that is or business that is, we help them build their wealth through real estate. They get to retire early. I mean, who doesn't want all of that?
For sure.
So, okay. Any other comments, questions?
What does hiring a property manager look like? Do you just go and post that on? It's kind of just like prospecting for a property manager at that point.
Yeah. So there's different property managers. There's the one that people talk about lately is incline property management. I don't know. I haven't worked with them. They actually have an office in our Cottonwood Heights office. But they're super cool. I haven't met them before, but property managers charge about 8 to 10% for long-term rentals usually. And then short-term rentals, they charge about like 30%, 25 or 30%, because short-term rentals are a lot more of a pain. There's a lot more that goes into it, but because there's a lot more people involved basically. So any other comments, questions? Okay, well, thanks for being here. Happy 4th of July. And let me know if we can support you this week. We'd love to do it.
You too. Thanks, Nick.
Thanks, guys. See ya.
Thank you.
Thanks, Nick.
Yeah, thanks, guys. See ya.